Urban Company's IPO is the hot stock everybody's buzzing about, and it's oversubscribed 104 times with a 70 rupee grey market premium, pointing to 68% listing gain. Debuting on September 17th, 2025, this 15,000 crore unicorn is red hot in the market. But does a PE of 65x make it overvalued? And should you simply do a quick flip, or is it like a long-term gold mine? We are breaking down why Urban Company could be in your portfolio's next big thing. Let's explore why Urban Company is in a gold mine sort of a market. India's home services sector is 5 trillion rupees and it's growing to 8.5 trillion by 2030 at the rate of 10 to 11% annually. Urban Companies 4.5 to 6.5% of the organized market share, okay, which is just 10 to 15% of the total market, leaves about 90% unorganized market up for grabs. International revenue, which is UAE and Singapore, okay, is growing at the rate of 50% yearly. And Urban Company has a first mover's edge with about 25 to 30% growth through 2027, which makes it a long-term winner for investors chasing big returns. With Urban Company's growth potential lighting up the market, let's shift gears to its valuations. Urban Company's 15,000 crore market cap with a PE of 65x at the price of 98 rupees signals it to be a pricey stock, comparable to buying at bull market peak. Zomato's post-IPO dip after similar hype serves as a cautionary tale. With 104x subscriptions and 70 rupees grey market price, okay, sustaining this valuation requires a consistent 25 to 30% growth. The net transaction value slowed from 50% in FY22 to 27.6% in FY23, driven by larger base and urban saturation at 10 to 15% in cities like Delhi. A 20 to 30% price drop is possible post September 17th if the growth falters. So investors should really wait for 3 to 6 months for a cooling off period and secure a better entry point. So let's now analyze the risks to ensure that you have a balanced mindset as your investment strategy. So the biggest strength of Urban Company is that it has a trained workforce. And training for Urban Company means that it is able to maintain a quality. But training is a key strength and it is also a investment. An annual investment of 100 crores is required for Urban Company to keep their 57,000 professionals upskilled, creating a really heavy ongoing cost on the balance sheet. And also, to scale rapidly, Urban Company must guarantee a fixed pay for its professionals. It is a risky strategy to retain talent and boost supply, replacing variable incomes that limit the growth because people are not participating because Urban Company does not guarantee a fixed growth. The competition also poses a significant risks. India's market is dominated by unorganized players, which is 90% of the market. And there are different apps like Bro4U and HouseJoy which can squeeze the margins. Our advice: time your entry or buy the dip to turn this overvaluation into an opportunity in the long term. Let's discuss benefits that make Urban Company a compelling long-term bet. It has the first mover's advantage with 82% repeat business. The 500 crores in IPO funds the technology alongside new segments like revamp, which could drive another 10 to 15% revenue growth by FY27. The gig economy with 7 to 8 million workers now is projected to grow to 23.5 million by 2030, which supports UC's essential services. Analysts project 15 to 20% annualized returns over 3 to 5 years and a potentially 2 to 3x by 2030 if Urban Company captures 10 to 12% of the organized market. Its 3.5 million monthly users compared to Zomato's 40 million could double through app partnerships. To top it all, we have also published an exclusive 3,000 word research report on Urban Company's future potential, loaded with projections and strategies. If you would like to get your copy, please subscribe and drop a comment with your email within this video. Okay, head smart and win big, but also subscribe and comment. Thank you for tuning in and thank you for your time.